newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we're ending the week with a rush to havens, stocks tumbling over credit fears of U.S. regional banks that's now hammering European bank shares. It follows a week of heightened trade tensions between the U.S. and China. Now, let's unpick geopolitics and, of course, the week of corporate earnings in just a moment. But let's begin with the credit troubles. And joining us now is Laura Cooper, global investment strategist and head of macro credit at Nuveen, and Bloomberg's Neil Callanan in charge of private company coverage. So thank you both for joining us. Neil, just set the scene for us. I mean, we know that there was, a couple of trouble at some of the banks. This is possibly because they didn't do what they should have. But then it's kind of spreading to the markets wider.
Yeah, absolutely. Jamie Dimon's comment earlier this week about cockroaches in credit markets mean people have been on the lookout for the next First Brands, the next Tricolor, and they think they found it with an alleged fraud that's small in the context of things. It's tens of millions, an alleged fraud at two U.S. regional banks. But people are wondering where the next big problem is going to come out in the markets, and so far it looks like this. And people, as you said earlier, are starting to sell rather than waiting to ask questions and get answers to those questions. And what we've seen is short sellers in particular have started looking at the US regional bank index. So there's been a big spike in short interest in the last couple of weeks. And that's just a sign that people think that some of the real estate problems that we saw 2 or 3 years ago haven't gone away, and fraud linked to those real estate problems, which has been an ongoing issue in the US, is also driving that.
I mean, I guess the concern, how much of this, Laura, is a concern about what's actually in there, or is it just nervous undercurrents running through Wall Street?
Well, I think what we've seen is this kind of benign credit backdrop has persisted for a prolonged period of time. And what the recent developments suggest is we are in late cycle dynamics. And so I think we are going to see greater pockets of these pressures materialize. And as the cycle turns, I suspect we're going to see even more, perhaps a steeper default cycle, lower recovery rates. But I think this is really an environment where we're going to see it's really crucial to have that robust underwriting, overlay that with the active portfolio management approach to be able for investors to discern the quality in a very complex, nuanced market when we kind of throw in the private credit dynamics as well. So I think this is an opportune time as we see these dislocations to find these opportunities.
But, I mean, to you both, was it a long time coming? Because actually, there was concerns about, again, the underwriting, the liquidity in some of these products. And so anything that makes people nervous, then people just sell off.
And I think it's too soon to declare this as kind of being an inflection point for a more systemic risk backdrop. I mean, overall, the backdrop for credit still remains quite healthy. The fundamentals are strong. We are still seeing favorable technicals. So it is still kind of a favorable environment for credit. But I think the more that we see these pockets materialize in unforeseen segments, perhaps then when the confidence channel could be hit. Banks are predicated on confidence. That's the signpost we'll be watching for.
Yeah, credit markets had been priced for perfection, so anything like this is going to cause a ripple effect. But what we've seen is credit markets have been far less volatile than equity markets for the last few years, in part because life insurers step in and start buying credit even when there are periods of volatility. And what we've got to see in the next few days is, does that happen? Do the life insurers come in, start buying things at a discount and calm the market down?
But, the correlation, so for, this is basically troubles at Zions, Western Alliance, so I know there's going to be a lot more regional banks that will be reporting in the coming days and weeks. But then you look at some of the European banks that are down 5%. I mean, what's the correlation?
I think a lot of those banks do have exposure to the US through various lines. A lot of them have auto lending businesses or still have some legacy commercial real estate assets, even though they've been selling those off. So that once you start seeing fraud and doubts about credit, it's going to spread to those banks who have more exposure. And so you saw the Spanish banks, some of the Spanish banks who were involved in M&A are down less than some of the international peers because they have less exposure to the US in that sense.
And Laura, of course, there's again this concern that credit markets and the banking sector at large can also have a direct impact on the real economy.
Of course, and I think we're not yet seeing signs of that. We're seeing signs of U.S. resilience. I think the key risk is we have this air pocket in terms of economic data that does leave kind of market participants to rely on shifts in sentiment on the U.S. government shutdown, kind of any signpost of the evolution of the economy. But I think at this juncture, we're looking at the Fed continuing to ease. We're looking at resilient corporate earnings, limited impact so far of the U.S. government shutdown so long as it doesn't persist for a prolonged period of time. all of that does suggest that there's reasons to still be cautiously optimistic on risk assets.
I mean, I like that, cautiously optimistic. So it's basically the question, is this a one-off or is it not a one-off? But if enough people think it's not a one-off, then you have this kind of panic selling.
Potentially, but again, that's going to drive, to Neil's point, this greater volatility, open up these opportunities. And I think so far we've seen very robust earnings come through. That's being driven by tech. It's too soon to declare any kind of AI bubble. A lot of that is being driven by robust demand. We're seeing a lack of leverage in that space as well, thinking about AI capex. So I think at this juncture, perhaps the risk is more about kind of prolonged valuation fatigue in the AI space. But overall, I think we're still constructive.
Neil, I mean, the other thing, when you look at Tricolor and First Brands, again, we spent a good amount of this week actually trying to see what the ripple effects of that were. We had some of the big banks and saying, look, this is our exposure, and they've disclosed that. How do we know when we've gotten to everything that we need to know?
I think we're going to look at least another week on that, because there's still so many threads being pulled that are coming out of the bankruptcy cases that are going ahead at the moment. And as you say, when it comes to allegations of fraud, there's sometimes surprises, and we don't know who's been sold what on what basis. So there's still things that may come out in terms of the receivables. There are still things that might come out in terms of who's got CLO exposure, etc. So we're still working through that at the moment.
Does it change actually the nature of risk in private credit, full stop?
I think, there's been a lot of talk about private credit and risk in private credit in the last couple of weeks. The one thing private credit has is an ability to modify loans that more so than banks do. And they push the idea that will make them, recoveries better than if it was a lending scenario from a bank. That test case hasn't been tried en masse because it's a relatively new asset class. So we're going to see, this is one of the first test cases for that, basically.
Laura, you intimated that this could be a good idea, actually, to find good opportunities. Where do you find those?
I think we are still seeing opportunities in the tech space in the U.S., but we're seeing the kind of disparate market. So some of those AI-adjacent smaller firms that are unprofitable are actually lagging, whereas those that are generating profits on the back of the AI capex so far are actually leading. And as well, looking at utilities and materials, they're expected to post robust earnings as well, and they're benefiting from the power generation demand, from the infrastructure demand. So really kind of continuing to see opportunities in that space. And then in the credit, yes, we are seeing these pockets of risk emerge, but overall still fundamental backdrop, as I mentioned. And even in the private credit space, looking at investment grade private placements, looking at private ABS, looking at some pockets of the U.S. mid-market lending, European upper mid-market lending, there are still opportunities, but this is really the ripe environment for that active security selection.
Laura, when you look at AI, I know you don't overall think there's a bubble, but could there be, AI pocket bubbles in certain types of companies?
I think that is certainly going to be the case. I think the key question is, will we actually see evidence of the returns on investment of some of these AI capex come in quickly enough to justify the spend? It's really, we could see this growing skepticism that we're not going to see the returns on this, that we have this, as I mentioned, this kind of valuation fatigue. Investors right now are paying up to capture this AI secular trend. And there's a risk that we're going to kind of see investors no longer want to participate in that. So continuing to pivot into those Mag 7 that continue to show just this robust profitability on the back of this expectations of what's to come.
I know it's a big week. I mean, it's hard to think actually that, the Gaza deal was only Monday, and then we had all of that political turmoil in France. What's the market pricing in terms of political risk?
I think the market is pricing in probably sufficient political risk if we think about France, looking at that Haute-Boon spread. I mean, we've actually seen probably a bit too much of a tightening on the back of recent developments there. I think the fact that they're going to abandon their pension reform really does keep us structurally underweight in French government bonds. Instead, we're looking more in the periphery for opportunities. And then if we think about the U.S., kind of the tariffs dynamics, the political backdrop, we're really seeing that play out in real assets. I mean, the fact that gold is up, almost 60% so far this year, there's probably room for a near-term consolidation on some of the back of the headlines more recently. But I still think there's this bullish case for gold. Notably, EM central banks are underweight. ETF flows continue to be supportive. And given the uncertainty heading into 2026, we still see investor appetite for holding those real assets.
And Neil, given you have the very easy job of leading the coverage on all private companies for Bloomberg, what are you looking for in the next 4 or 5 days? What are your reporters working on?
We're mainly looking at the next outflow from First Brands and Tricolor as well, and what's going to happen there. And then, obviously, we're looking at BDCs and the impact that that's been had on them as private credit lenders into the market space in the US. Those are kind of the main threads for us to pull on in the next week.
Okay, and then let's see if we have data. We have private data. We don't have, of course, the data because of the shutdown in the U.S. Thank you both for joining us. Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen, and our very own Neil Callanan. Now, it's also been a major week, as we were just saying, of geopolitics and corporate earnings. In just a moment, we'll discuss some of the big tech and bank results. But let's begin with President Trump, who's also spoken with the Russian President Vladmir Putin ahead of his meeting with the Ukrainian President Zelensky later today. Well, we're joined by Chad Thomas, Bloomberg's Europe Executive Editor. So, Chad, I mean, it's incredible when you think, what we've had in terms of breakthroughs in the last 5 days. Now the focus is clearly on Ukraine. Do we know what President Trump administration want to achieve today?
Well, Francine, it's obviously a big risk for President Trump setting up the second meeting with President Putin. There was the meeting in Alaska. That momentum seemed to have faded very quickly. I think having one meeting, from Trump's perspective, he can say, I tried. Now setting up the second meeting, it means that he is putting some political risks there to see if he can actually gain some momentum. But clearly, President Trump feels that the momentum is with him off of the news that we've been following so closely in the Middle East this week and the peace agreement there. And so he has decided that he is going to try again and has set up this meeting in Budapest. We don't know yet when that meeting is going to take place, but a meeting with President Putin in Budapest sometime within the next 2 weeks.
Chad, I know there's a number of also opinion pieces on saying, look, maybe we need troops on the ground, U.S. troops on the ground to make sure that the Gaza peace deal continues. But has this week really emboldened the president and U.S. foreign policy?
Well, he certainly seems emboldened and is trying to. He believes he can singularly secure a peace deal between Russia and Ukraine, and so he has said he would move forward with this meeting. I think some of the tough talk that we've heard from President Trump in the last couple of days regarding Russia, this means all of that gets pushed out by at least a couple of weeks. There had been seemingly some momentum around potentially giving Ukraine Tomahawk missiles. President Trump, though, said yesterday, late in the evening, that in fact that the U.S. needs those missiles. So that he seems to have changed his language there a little bit. There's also a bill in the Senate that would put more stricter. Put more sanctions on Russia and those buying Russian energy, and that seemed to also be moving forward. Then President Trump said again yesterday that maybe now is not the time for that. So it seems that President Putin has bought himself some time here, and that President Trump is going to keep talking before he moves forward with any of those measures that had seemed to be moving forward in the last couple of days.
Terrific briefing, Chad. As always, thank you so much. Chad Thomas, of course, in charge of all of our Western, economies and politics. Now, to earnings now, we're joined by Tim Craighead, Global Chief Content Officer and Director of Research for Bloomberg Intelligence. It's been a big week. It's been a big week, actually, on all fronts. But earnings have been really left, right, and center. Like, who's beat expectations?
Yeah, it's early days still, but we are seeing something like 60% win, 25% miss, and a little bit in between. So it's skewing to the positive. Who's done well? Think AI, TSMC, ASML, both of which surprised on the upside. TSMC has raised their sales guidance. ASML had strong bookings that, has caused positive revisions. You've also got EssilorLuxottica that had a positive surprise based off of glasses, but it's Meta's glasses, and so it's AI enabled. So that's one. Second, we've had positive news out of U.S. capital markets, the big banks, and that has repercussions, we think, with a tailwind to European banks to come. There's also been some beaten up consumer names that have positively surprised. LVMH, most notably, with stabilization and improvement in China, which shock of all shocks, was a big deal. Nestle also a positive surprise, more on restructuring, but still their volumes were a little bit better than expected. Those can all read maybe into SAP, Kering, Barclays next week, which are all focus ideas, by the way.
So, Tim, I like the focus ideas. They're terrific. I love the in focus stuff. So who should we worry about? And is it sectors or is it companies?
Yeah, I guess the things that jump out to us, number one, we're always still looking for, is there an AI soft belly? We haven't seen it yet. Secondly, tariff impacts. Think Volvo that reported a miss. And that's global trade, container shipping. You don't need as many trucks. U.S. sales were weak. That's an issue. And then you've got this undercurrent of what happens on credit quality. Is there something to worry about in Europe from what we're seeing in the U.S.?
Tim, let's see. It's going to be a big week. I feel like it's going to be a big day and then a choppy, possibly weekend as we get caught up on what's happening on Monday. Tim, thank you, as always. Tim Craighead from Bloomberg Intelligence. Now, coming up, how the U.S. and Europe look to tackle China's stronghold on rare earth supply. We'll be joined by the co-founder and managing director of the Critical Minerals Hub. That's next, and this is Bloomberg. Well, as the U.S. and Europe look to take strategic steps to tackle China's stronghold over rare earth reserves, is Beijing's grip leading to a redrawing of the world order for the industry? Well, to discuss all of this, we're joined by Amanda Van Dyke, co-founder and managing director of Critical Minerals Hub. Amanda, thank you for joining us. I mean, this is basically critical minerals for a reason, because it kind of like changes everything, our prospects for the economy. What do we know about U.S.-China right now? China has such a big grip on this. Could it actually shape this new world order?
Definitely. When it comes to most critical minerals, rare earths included, China owns 70 to 90% of processing. And processing is where they exert their control. Because we can't actually, there's no use having the minerals just as they come out of the ground. You need to turn them into a usable mineral, and that processing is often very complex and difficult. And China's done a lot of investing in securing control over the processing choke points in the world. It all goes through China. That means that if we want to build anything from F-15 fighters to EVs to iPhones, we need materials that come from China. In terms of the U.S. and China, they had a handshake. They had a handshake deal that said, we will continue to provide you with what your industry needs. We'll continue with the supply chain. And then suddenly, for some reason, Xi, right before they were set to start talks on their new set of trade talks, decided to put out an export ban on processed rare earths, as well as any technology required to process them. So basically the IP. They controlled not just the metals themselves and said that we've got an export ban on them. You have to buy the value-added EV or battery or something like that, rather than the actual, you can't buy the metals or even the magnets.
But is this a declaration of ratcheting up a trade war, or is it a negotiation tactic?
They're ratcheting up a trade war. There's just no other way to do it. The U.S. actually recently rejigged the way in which they have a critical minerals list, as do many countries in the world, that says what minerals do we need that are critical to our economy. But they went one step further, or two steps further, actually. They calculated the risk of shortages based on a number of factors, and also what a shortage would cost the U.S. economy specifically. I'll give you one.
This is what, in the short term or the medium term? So this is like, look, if we don't have access
in a year, so in any given year, yeah. So I'll give you. So there's 17 rare earths. One of the smaller ones, is one called samarium. The total value of the samarium market is only about $30 billion a year, and how much the U.S. imports, usually in the form of permanent magnets, is only about $10 billion a year.
Right.
That's not very much.
Right.
But they calculated that if they got their access to samarium or samarium permanent magnets cut off, it would cost $4.5 billion. it's $10 million worth of rare earths would lead to $4.5 billion in economic damages for one single out of 17 rare earths.
Because you use it in what components for?
Tiny
for everything.
Little batteries that go into
our phones, I imagine, like
our
renewables.
Phones, basically every technology, every electric motor, so every bit of electronics we have has a number of electronic motors in it. Every server, every phone, every radar system, everything. Every electronic component has small permanent magnets in it, and they're usually powered by rare earths.
So what does that? So the U.S. is now trying to get, I guess, a deal on this. But does it change the psychology on what the U.S. wants from China?
Well, the U.S. had this handshake deal. They had a 20% tariff. In exchange for a handshake on, we will continue to supply at the rate we were supplying. So we have a million different manufacturers of a million different electronic products said would keep the supply lines going. They pay for them, of course, at whatever value and whatever tariffs are required, but they would keep the supply. Now there's export quotas. They can't get them at all. There's no way that those kind of export quotas could be considered anything other than a desire to hurt the American economy.
But Amanda, if you have a list and saying, look, if I go tough on this, then it will cost me this in 1 year, does it mean that they can actually negotiate more smartly? Potentially.
Potentially they could. It depends on how important the U.S. consumer market is for Chinese goods, because that's what they've said in return. If you're going to make all of our consumer products put all of our production lines at risk, then we're going to put all of your production lines at risk because we're your biggest. They are still the biggest customer for consumer goods
overall. So interesting.
Yeah.
Thank you so much. Thank you, Amanda van Dyke, there, co-founder and managing director of Critical Minerals Hub. Now, the picture, look, stocks are definitely extending their gains. There are many, many doubts on the credit health of regional U.S. banks, and that's really driving traders to cut down on risk. And this caps a pretty volatile week that exposed the vulnerabilities of markets near record levels. Now, what is quite incredible is that these are two regional banks in the U.S., and they seem to be infecting a lot of the big European banks. Traders seem to be in a mood of sell now and ask questions later. Deutsche Bank down 6%, Barclays, Standard Chartered down between 5 and 5.5%. Then Banco Sabadell also has the extra layer of an M&A that did not work out. So that stock's down 7%. Our Kriti Gupta speaking to the chairman earlier. Coming up, all that glitters is currently gold, but for how long? We talk gold next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European bank stocks slump as a sharp sell-off in U.S. regional lenders ripples through global markets amid growing credit concerns. Ukrainian President Volodymyr Zelensky arrives in Washington for talks with Donald Trump, who now says he will meet Vladmir Putin in Budapest within 2 weeks. And the White House is poised to ease tariffs on the U.S. auto industry in a move that would deliver a major win for carmakers. Now, gold has surged to another record as fears about credit quality in the U.S. and trade tensions between Washington and Beijing strengthen demand for havens. Valerie Teitel is here with more. Hi, Valerie.
Hey, Francine. Gold up again strongly on the week. Gains of near 8% this week alone. It is headed also for 9 straight weeks of gains. If we reach 10, Francine, that's something we haven't necessarily seen in modern history. I wanted to look back on history and just compare when else we have seen a jump of near 8% when it comes to gold. Let's flip on because we've only seen it, Francine, 4 other times in the last 20 years. One during March 2020. We also had a similar rise around 8%. And then twice or 3 times, shall I say, during the 2008 and its fallout. Once during September 2008. We all know what happened then. And then twice during October 2008. That's when we saw the riots in Greece first beginning. So a move like this is something we have not seen very often in modern history. And the recent move today is all in the back of these credit jitters coming out of the U.S. regional banks. Zions Bancorp is moving lower yet again in pre-market. It closed at the lows in yesterday's session, down over 13%, adding to those losses today, down just shy of 2%. Fran?
Valerie, thanks so much. Valerie Teitel with the very latest on market moves. Now, gold record-breaking rally is the subject of today's weekly doc from Bloomberg Originals. It looks at what is driving the surge and what it means for the global financial system. Here's a preview.
Metal is having a moment. Not this kind, though, sadly.
Gold hits another record.
Spot gold prices have climbed above $4,000 an ounce for the first time.
The key word is scared.
During times of economic and political and financial turbulence, you buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating. Excitement is evident online, on shopping streets and in capital markets.
Just gold, gold, gold the whole time.
This gold rally really looks unstoppable at this time.
With any rally, it naturally makes people worried. Is this a bubble? Is this going to pop soon?
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Well, you can stream that full Bloomberg Originals doc on the terminal and Bloomberg.com. Now let's continue the gold conversation with Michael Haigh, head of FIC and Commodities Research at Société Générale CIB. Michael, thank you for joining us. Gold. I mean, gold is like on a tear. Is there anything that can stop its upward trajectory?
I don't think so in the short term. I mean, gold thrives on uncertainty. We've had an event today. Obviously, we don't really know what's pushing it up in terms of hedge funds or ETF flows, etc., because we don't have government data anymore on hedge funds participating in the gold market. But ETF flows have been rampant. So I'm assuming it's that. I'm assuming it's hedge funds. Before the government shut down in the US, notionally, hedge funds were holding the biggest gold position they've ever had. And they held it for weeks. In the past, you'd see them sell off when you get prices this high, but that hasn't been happening anymore. So in the short term, I don't see this changing.
Michael, I had a good conversation actually with the Citadel founder, Ken Griffin, last week, and we're talking about, de-dollarization. Yeah. And he said, look, there's only one thing that people go into, and it's gold. Yeah. So if this is actually Asian economies and other economies saying, because of what's happening in the U.S., I'm going to stop buying treasuries and get into gold, and stop buying dollar and get into gold, I mean, I don't know what kind of price we could see for gold. So
this is how we actually come up with our forecast. If you look at, say, for instance, China's foreign reserves, 3.6 trillion roughly, of which about 9% is in gold. It was 6% at the start of the year. Just because the prices have increased so much, it's now at 9%. If they go to 20%, which is kind of normal, that means they need to buy another 3,000 tons of gold. So what they normally buy and what we track is about 30, 40 tons coming out of the UK into China. So you're talking about many, many years of buying to get to that level.
But is there a clear correlation that we can see now with people actually wanting to get out of US assets?
You see that data with a lag, the tick data. Of course, there's about 63 trillion foreign holdings in US assets. In 2022, we saw a 15% decline in that. We haven't seen it at that level yet. I'm assuming, to your point, that we see something like 7% decline in those holdings, and that's how we come up with what would go into gold as a result of that.
Okay, when you look at the next couple of weeks and months, again, there's so much concern for, there's credit quality in the U.S., there's a lot of tensions between, Beijing and Washington. Again, how much is that just the daily anxiousness in the markets driving up gold?
So my favorite thing to look at right now are these uncertainty indicators that you can find.
I love an uncertainty
pretty
indicator.
Much anyway. So there's an uncertainty indicator about the military, about trade, about economic policy. There's daily versions, weekly, monthly. So the Chinese have a monthly version. It's risen again. The US version is really, really high relative to what it normally is. So these uncertainty indicators before we had Donald Trump averaged around 100, let's say. They spiked to 600 at Liberation Day. Now they're around 200, 300. It'll go up again today. And that's what's driving these flows.
Do you worry about the credit quality in the U.S.? I mean, could there be something seriously wrong? Or is this just a little bit of a panic or, positioning in case something goes wrong?
You've been saying this all morning, that people are selling it now and asking questions later. I think that's exactly the situation. It's probably the same with gold's reaction today. Yeah. Buy it now and let's see how this turns out. But whether or not that sells off when you see some sort of resolution, if you get it with the credit, I don't know, and I doubt it.
Michael, what can you tell me about physical demand for gold? Because this, again, we kind of forget. Back in the good old days, 4 or 5 years ago, I mean, this was still a huge, huge factor in the price of gold rising. At some point, it's so expensive that you must see demand being, destroyed.
Yeah, these measures of elasticity of response to gold prices on demand, whether it's ETF, central bank buying, or even retail, they've all broken. So there's no way of assessing anymore at what price it would go to where this stops, because it's all broken and now everybody's buying for strategic reasons rather than economic. So it's kind of hard to put a number on that. Our forecast for gold is 5,000 by the end of next year. I'm going to guess we're probably going to get there a lot faster than what I think we were going to get based on the flows from retail, ETF and central bank buying.
You mentioned the China Central Bank. Who will be the biggest owner of gold apart from the Fed? Is it impossible to say?
You mean in terms of the central banks?
Yeah, in terms of central banks.
Well, central banks. So the US has 8,000 tons.
Yep.
Germany's the second biggest, I think. I can't remember exactly their tonnage. China has about 2,300. Russia has 2,300. The US is by far the one that's out on a limb in terms of 80% of all reserves being in gold. But as you're probably aware, the US value on gold is at $43 an ounce. It hasn't been changed since 1973, exactly. And there's obviously conversations about whether that gets marked to market and what that would mean. Yeah. But so there's no bank anywhere close to the US.
Michael, give me a sense of, again, is there something else out there that could replace gold? I don't know. I know it's kind of, there's silver is going up, but could there be a digital currency? Could there be a yuan or a euro?
We get this question on the crypto and whether or not banks are interested in going that. So far, from what I've read, Switzerland said no way, they would never entertain that idea. The Czech National Bank has said they might. Kazakhstan has said they might, but most banks have said no, we're not going to entertain that idea. So I don't see anything being replaced. We don't see any silver going into central banks of any kind of size. So
Swiss franc? There must be another. I mean, is it crazy that the biggest kind of safe haven is gold, full stop?
No, I mean, you can't assume that everything that comes out of US holdings of treasuries or US assets all goes into gold. That's impossible.
Right.
So it has to find a home, in equities. It has to find a home in real assets, for instance, not just gold. That would be that just couldn't happen.
But even if you had 40%, right, of money coming out of some of the U.S. assets going into gold, it's very significant.
It's hugely significant. So I mean, I'm assuming, of the 7.5% that I'm assuming comes out of U.S. assets, which is 63 trillion, I'm assuming of that 7%, 3% of that value goes into gold, spread over 4 years, and that gets a return of roughly 4 to 5% a quarter on gold, just on those flows alone, nothing to do with the ETFs.
Michael, so you're expecting 5,000 by the end of next year.
Yeah.
What happens by the end of this year? We could be
almost,
4.5?
Our forecast for January is 4,400. We're pretty much there, and I hate to keep revising up these forecasts every single week, but. It's really getting ahead of itself. And again, as I mentioned, we don't exactly know what's going on in the hedge fund space and whether or not they're pushing it up because they're maxed out notionally. But my hunch is that they've become very comfortable with the idea within their macro portfolio that gold is actually an oversized position now, whereas previously they would sell it off and keep it at a lower level. So I don't see that reversing.
Michael, thank you so much. What a great conversation. We've talked about gold all day. Michael Haigh, head of FIC and Commodities Research at Société Générale CIB. Now, U.S. President Donald Trump says he plans to hold a second meeting with the Russian President Vladmir Putin within 2 weeks. It comes ahead of a meeting he's due to hold with Ukraine's Volodymyr Zelensky later today.
I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. Tomorrow I'm meeting with President Zelensky, and I'll be telling him about the call. We're going to be meeting in Hungary. Viktor Orban is going to be hosting, and it's really something that's time. Last week over 7,000 people were killed. That's ridiculous.
Well, to look at geopolitical ramifications, we're joined now by our very own Ros Matheson. Ros, so does this actually undercut any Ukrainian push?
Well, possibly it's a bit disappointing for the Ukrainian leader that Donald Trump had this phone call with Vladimir Putin ahead of his own meeting with Donald Trump today, because there had been a sense for a while that Donald Trump was cooling on Vladimir Putin. He was quite frustrated with Putin and his foot dragging on ending the war in Ukraine. I mean, Zelensky obviously also wants to end the war in his country, but he wants to do it on the strongest possible terms. And the concern is that Donald Trump, in his eagerness to get this war finished, a ceasefire in place, does he push Ukraine towards concessions? And so there's going to be obviously an incentive for Zelensky in his own meeting today to try and encourage Donald Trump, keep up the pressure on Russia, keep up the pressure on Vladimir Putin. You know, there are two things he's probably concerned about in all of this. Is the US going to, drag their own feet on supplying Ukraine with Tomahawk missiles, for example? Is Donald Trump going to walk slowly on trying to get more sanctions put on Russia through the US? Are those things going to slow down because he wants to have his meeting with Vladimir Putin in a few weeks and see how that goes? So again, is this kind of dragging things on and on to Russia's advantage? And so possibly a bit of concern there, at least in the Ukraine camp today, and a bit of requirement here for Zelensky to go very carefully in his meeting today with Donald Trump and perhaps reset the table just a little bit.
Ros, what's the likelihood of Donald Trump bringing an end to the Ukrainian war?
Well, obviously, he's fresh off his ceasefire in Gaza that the US did arguably, bring that pressure to bear to get Israel and Hamas to agree to that ceasefire. But the war in Ukraine is just as complicated, really. And there's no great sense from Vladimir Putin that he's in a rush to end his war. He's got long-standing territorial gains that he wants to make. Russia's continuing to attack Ukrainian energy infrastructure, particularly going into winter again in Ukraine. There's no great let-up in that. And so for Vladimir Putin, he really needs either pressure or incentive to end his war. And there's no sign that he particularly sees either unless the US really turns the screws on his economy. So, the first meeting between Vladimir Putin and Donald Trump in Alaska didn't produce really much of anything. There's a bit of risk there for Donald Trump as a result. Can a second meeting produce anything? But Vladimir Putin doesn't seem to be in a hurry.
Ros, thank you so much for the terrific briefing. Let's see what comes out of the phone call later today. Ros Matheson there on Ukraine. Coming up, Bloomberg's Michelle Hussein joins us to discuss her new show that's launching today and her interview with the Canadian Prime Minister Mark Carney. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, Volvo shares falling the most in 6 months after the truck maker warned that demand slowdown was sparked by uncertainties over tariffs, and that will extend into next year. Well, we're joined by our very own Craig Trudell, our global autos editor. Craig, I know you've been extremely busy, but when you look at Volvo, they see quite a lot of weakness in North America. What else jumped at you?
I think just the parallels between what Volvo had to say this morning and what we heard from Michelin earlier this week, that there's just seems to be a real consistency across the sector of issues with a freight slowdown, weakness in agricultural, demand in particular, and that this is a case where there's sort of nowhere to hide if you're in the sector, between on the demand side, but also the pressures that the Trump administration is now putting on this sector after, for up to this point, it's primarily been a case of cars. We're now getting into medium and heavy duty trucks as well. And so whereas we've seen a lot of tumult on the car side this year, maybe 2026 is the year that we see much more of a bite for the trucking sector.
Craig, we've also had new lines this morning from Porsche. It's quite unusual. I mean, they're saying they're in talks with the ex-boss of McLaren for a potential CEO role. I mean, it's quite unusual to know about the talks before he gets signed.
Yeah, it's an interesting one. It's not necessarily a surprise that we're learning that there's been a decision to move on from Oliver Blume because of the fact that he's been wearing two hats, that he's been head of Porsche and Volkswagen. That was, controversial, sort of from the beginning when Porsche was, staging its initial public offering. That IPO went quite well, and yet in the years since the listing, things have not gone well whatsoever. And so the Volkswagen Group wanting to, in this case, bring someone in, and Michael Lieders, who spent time at Porsche, spent more than a dozen years there before going to Ferrari and then to McLaren, had quite a bit of success at McLaren. So in terms of someone to come in who is familiar with Porsche, but also has a strong track record, this makes a lot of sense in terms of a natural successor to Blume for that role, so that he can turn his attention fully to Volkswagen.
Yeah, and we know that the car maker was actually looking for a successor for quite some time. Craig, thank you so much. Craig Trudell there, our global autos editor. Now, it's launch day for Bloomberg's The Michelle Hussein Show, a new weekly podcast which aims to make sense of the world with one essential conversation every weekend. The debut interview is with the Canadian Prime Minister and the former Governor of the Bank of England, Mark Carney, and I'm delighted to say that Michelle joins us now. Michelle, I'm so excited to listen to this podcast because the show is chaotic, and that's probably the understatement of the year. So what are you trying to do with this new podcast?
It's such a pleasure to be with you, Francine, and so soon after your own series, Leaders with Lacroix, has begun, which has been a brilliant watch. I think what I'm really trying to do with the Michelle Hussein Show is try to get a balance between the complexities of our time and the human and personal side. So while we will speak to newsmakers, and the first two episodes, Mark Carney, and episode 2 will be Nigel Farage, they are people in that zone. But we'll also be talking to thinkers and experts and people in the cultural space. So I think it is about people who are shaping our world and people who can help us make sense of it all. So it's going to be a space for wide and deep conversations. And not everyone falls into that category, right? You've got to have enough range. Often we're going to be talking to people about their past as well as their present.
Yeah, I love that you spoke to Mark Carney because he has a difficult job, right? I mean, he's right close to the U.S. And so I know that you talked to him about how to deal with Donald Trump, and this is what he had to say about that.
Have I learned? I've learned lots of things from
like
President
what?
Trump. You always learn things from people. I've learned that the value. I don't fully subscribe to this, but I see the effectiveness. The value of the term they would use is flooding the zone, of doing multiple things at the same time, and the effectiveness that can have. I think that he has a very effective way in his own almost unique manner of framing issues and of dominating the agenda, if I can put that way as well.
I mean, he's been also quite amazing, actually, at doing this balance of humor but seriousness with Donald Trump.
Yes, and this is an admission of what he's learnt in communication terms. But he did also say to me, when I said, what have you found hard about this period? Because remember, he's cast himself both as the political outsider and as someone who's experienced enough to lead in this moment. And he did say that he used the word relentless, that it's as close to 24/7 as possible, which he says he conceptually knew from the outside, but actually living it is something quite different. But I think it's really important to say that this is the human side, but on the complexity, he really helps us understand what it is like leading an economy which is in the midst of what he calls a rupture. He says, we, Canada, never want to be in this position again, essentially the position that the United States has put us in, where a country to which we are so interlinked in every way is leaving us now having to search for new export markets and to export east and west as well as south. So he calls it a rupture, and I think we get a sense of the global moment as well as the personal side of a G7 leader through this conversation.
Yeah, they're so close. I think at times it was really quite an emotional conversation, right? Talking about the next Canada. What did he tell you about climate change?
Well, climate change was a particularly interesting aspect of this to me because the last time I spoke to him on air was at the Glasgow climate talks, and he was then the UN envoy on climate action and finance. So these are issues he's been really outspoken about. When he led the Bank of England, he was talking about how short-term thinking on climate is such a problem. His first action in office was to cancel a consumer carbon tax, and I asked him about that. And essentially, he uses the words, I'm still the same me, and he smiles about that a bit. So he can see why I'm asking the question, like, are you essentially seeing climate in a less urgent way than you did when you worked for the UN and when you spoke out on these issues? Essentially, he's saying he's got a lot to juggle and he's trying to find the most effective way to act on the climate.
And here's Carney on climate.
What we're focused on, look, you can say there's a cap, but saying a cap doesn't make it happen. What makes the emissions go down in the oil and gas sector, as long as Canada and America are using oil and gas, and we are, our economies are wired for that, as is the rest of the world. What makes those emissions go down will be carbon capture and storage, particularly in other efficiencies.
So you are dropping it then? That's what it sounds like.
We're dropping emissions from the oil and gas sector.
Dropping the cap.
Dropping emissions, Michelle, from the oil and gas sector. This is the point. This is about results. The climate cares about results.
Okay.
It doesn't care about a policy that is... An outcome is not a policy. A desired outcome is not a policy.
So I'm getting the strong signals that particuch policy to have a cap on emissions from the oil and gas sector is not going to happen.
An outcome is not a policy. What makes a difference to the climate is whether or not emissions come down.
So I should probably explain that he's talking about a particular emissions cap on the oil and gas sector in Canada, which was promised by the last government, and there's a big debate about whether it's actually going to come in, and the signals are going in one direction on that. But again, it goes back to this idea of the hard realities. Also for him, the realities between the kind of language you use when you're campaigning and when you're governing, because he, at the point of campaigning, would say, I'm going to stand up to President Trump as a bully, and then it's different when you're actually sitting in the Oval Office with him.
I know, and what I love, you've spoken to like such varied leaders. So it was Elon Musk, it was Keir Starmer, and then Nigel Farage. Like, is there a common thread amongst all of them?
Well, I think the key thing I want is also enough time to talk to them in this particular format, to have a long conversation. And what I found so far is that for the most part, even though people operate in sound bites and so many people consume news in sound bites, there is a space for this kind of conversation. And people, I think, even people who have very little time do relish having that kind of opportunity to explain themselves, and they have to understand in that process that some of what comes back at them is going to be uncomfortable. But I think that this conversation is really setting the tone for what we want to do week after week, weekend after weekend, because this is a weekend listen. This comes from Bloomberg Weekend. You hope people have a bit more time to absorb what's being said and to leave with something of value.
Michelle, thank you so much. Michelle Hussein there with the Michelle Hussein Show, which debuts today. Her full conversation with the Canadian Prime Minister Mark Carney, available right now. You can also search the Michelle Hussein Show wherever you get your podcast. Now, it is a big day also for the market, so watch out for anything in terms of credit. We're actually expecting maybe a little bit of choppiness. I feel that the mood of the day is definitely a sell now and ask questions later. You can see Western Alliance pre-market down 2.6%. Up next, Bloomberg Brief, and this is Bloomberg.